Good morning. I'd like to thank the Mena conference organizers for inviting me to come and speak at this conference. It looks like a very interesting and very stimulating 2 days. The question posed to me by the conference organizers was, what will trigger the next commodity boom? And the answer to this question, of course, is very complex, because the world economy right now is confronting a variety of challenges. The best news in recent months is the U.S. economy. The U.S. is now showing signs of breaking out to a growth rate in the 3 to 3.5% range after languishing for 5 years at a 2% growth rate. And there are various factors driving U.S. growth. Our capital stock is now the oldest it's been since 1958. Firms have to increase investment to bolster productivity. The average age of a U.S. car is 11.8 years. 20 years ago, it was 8.5 years. New cars are very fuel efficient compared to the older cars, so households, I think, have a clear and compelling reason to keep buying new cars. Housing starts are currently tracking around 1 million, but if you look at household formation rates and homes damaged each year by fire, we need about 1.6 million houses per annum. I think we'll get back to that number over the next 2 or 3 years. The U.S. banking system has recovered from the financial crisis we had 6 years ago. Profits are back to where they were in 2006. Equity asset ratios are much stronger. Finally, we have an oil and gas boom going on. The U.S. oil output's gone from 5.5 million barrels 5 years ago to over 8.5 million barrels today. The Federal Reserve is also going to support the recovery. There's been a lot of speculation in recent weeks about when the Fed may act. The consensus right now on Wall Street is next June, with a few outliers saying March. The reality is nobody, including Janet Yellen, knows when it will happen because they have to watch the economic data over the next 6 months to make a judgment. Janet Yellen said last week at the IMF meeting, if U.S. data is incredibly strong, she'll raise rates earlier. But if we have a more modest growth rate, still positive but modest, it may not be until the middle of next year. But the most they will do next year is about 1%. They will not go to 2 or 3%. So it will be a gradual process. As a result of these positive factors, the U.S. will increase its metal consumption. The problem is the U.S. share of metal output or metal consumption has declined quite a lot over the last 10 or 15 years. The U.S. share of refined copper consumption has fallen from 20% back in 2000 to 9% in 2014. The U.S. share of refined lead has fallen from 26% in 2000 to 15% in 2010. The U.S. share of zinc consumption has fallen from 15% in 2000 to 7% in 2010. North American share of global aluminum consumption has fallen from 27% in 2000 to 11% in 2013. The U.S. share of refined nickel consumption has also fallen from 13% in 2000 to 8% in 2010. The U.S. will pose a further challenge to the metal markets because I expect the U.S. dollar to be relatively strong in the year ahead. The Fed will be raising interest rates at some point next year. Over the next 9 months, we're going to see easier monetary policy in Europe and Japan. And that divergence in monetary policy will, I think, make the dollar relatively strong. I could see the euro by the middle of next year at 110. I could see the Japanese yen possibly 115. If we do have a strong dollar, that can sometimes hurt commodity prices, especially gold. The Eurozone economy has been stalling because of the legacy of the financial crisis we've had over the last 4 or 5 years in Europe. France and Italy are trying to contain their fiscal deficits. Germany does not want expansionary fiscal policy because it doesn't believe it should give up its budget surplus. So we've got stalemate. But there is some growth going on in Spain, Portugal, and Ireland after very devastating downturns in 2010, 11, and 12. The strongest economy in Europe is the UK, where growth could exceed 3% this year. The European Central Bank is concerned about falling output growth and low inflation, so it's reduced interest rates close to zero and is about to begin purchasing asset-backed securities. Draghi has said in his recent press conference he would like to increase the European Central Bank balance sheet by €1 trillion. He can do that partly by a special lending program for the banks. He can do it somewhat also by buying asset-backed securities. But the fact they will at most represent about 300 billion euros. If he really wants to get the balance sheet up by €1 trillion, he will have to buy government debt, quantitative easing. The Bundesbank is opposed to this, but Europe is so weak, I think Draghi can win a majority of votes on the European Monetary Policy Council to go ahead. The EU is also consuming less of global metal output than it was 10 or 15 years ago. The EU now accounts for 9.3% of global steel output. EU accounts for less than 20% of refined global copper consumption, compared to 30% back in 2000. The EU accounts for 17% of global zinc consumption, compared to 31% back in 2000. EU accounts for 20% of primary aluminum consumption, compared to 29% in 2000. EU accounts for 25% of global nickel consumption, compared to 40% in 2000. If we turn to Japan, Japan is now struggling to cope with the big increase that occurred in the value-added tax last April. It went from 5% to 8%. This has very much crippled Japanese consumption. The economy could be, I think, very, very weak in the third quarter and possibly also the fourth quarter. The government wants to try and basically revive the economy, so it's lobbying the BOJ to have an even more expansionary monetary policy. But Central Bank Governor Kuroda made a speech last week at the IMF meeting saying he does not feel he should do more because Japan's potential growth rate's only 0.5%. We already have relatively high levels of resource utilization. So it's unclear if Japan will do anything. And Japan, again, after a long period of stagnation, now accounts for a lot less of global metal consumption than it did 15 or 20 years ago. It now accounts for only 4% of global copper consumption, compared to 15% back in 1990. The most critical factor, of course, for the global commodity outlook is the Chinese economy. China has slowed from double-digit growth rates 3 and 4 years ago to only about 7.3% growth so far this year. China confronts a variety of challenges. During the global downturn of 2007-8, China lost 20 million manufacturing jobs, so it embarked upon a highly stimulative fiscal and monetary policy. It announced a $600 billion infrastructure spending program. It allowed bank lending and money supply to increase by 30% during 2009. The infrastructure spending helped to boost the investment share of GDP to 49%, one of the highest levels ever to occur in a major country. China's economy is slowing because fixed investment is under downward pressure from the real estate market. After a robust 2013 performance, housing had a weak start in 2014. In the first 8 months of the year, real estate transactions fell 8.5%. Home inventory in the 10 largest cities rose from 10 months of sales during January 2014 to almost 18 months in April. In some Tier 3 cities, the excess supply of housing is over 25 months. China had a housing boom 2 years ago with strong demand and rising prices. The government was concerned about real estate inflation, so it tried to contain the boom. 53 cities imposed bans on people buying multiple homes. In June 2013, the central bank tightened monetary policy and to discourage the growth of leverage. As a result, real estate developers have faced higher funding costs and more restrictive credit availability. As the economy's growth rate is now threatening to drop below 7%, the central bank has taken steps to bolster the property market. It has asked the big four state-controlled banks to increase mortgage lending and to offer 30% discounts on the central bank's mortgage benchmark of 6.5%. The discount could reduce borrowing costs on mortgages to just over 4.5%. 47 cities have also gotten rid of the bans they imposed on multiple buyers during the boom 2 and 3 years ago. Developers are trying to reduce their inventory by cutting prices, but the fact that prices are falling is encouraging potential buyers to defer purchases until they are certain prices have bottomed. It will therefore take several months to get inventory back in line with final demand. The fact that China is still urbanizing at the rate of 15 million people per annum will ultimately absorb this excess supply, but it may take at least 9 or 12 months to catch up. There will not be a property crisis in China, though. compared to what the US and Britain had 5 years ago, because many people buy homes in China for cash, and mortgage debt is only 22% of GDP, compared to 70 or 80% of GDP in the US and the UK. The property slump will depress output because housing accounts for about 15% of GDP or 25% of investment spending. The weakness of China is the major negative in the mining outlook, because China now is by far the dominant consumer of all metals. China now accounts for 46% of global zinc consumption, compared to 16% in 2000. China now accounts for 42% of global copper consumption, compared to 13% in 2000. China now accounts for 46% of global nickel consumption, compared to 5% in 2000. China now accounts for 47% of global demand, compared to 14% in 2000. China now accounts for 56% of global iron ore consumption, compared to 14% in 2000. It's very, very clear from these numbers that the central issue in the mining outlook will be what happens in the Chinese economy. We've had a lot of pessimism on China recently, but there is one prominent optimist I talk to from time to time who thinks China can retain a high growth rate. His name is Justin Lin, and he was, 3 years ago, the research director of the World Bank, the first ever Chinese to hold that post. He's now back at Beijing University holding forth in the Chinese economy. And he gives me one clear argument for why China should stay strong, and that is its relative income compared to the United States. Right now, China's per capita income is about 21% of American levels, quite modest. That's where Japan was back in 1951, where Singapore was in 1967, and Korea and Taiwan in the early 1980s. After all four of these countries passed this threshold, they had 20 years of very strong growth. Japan almost 10%, Singapore almost 8%, Taiwan 8.5%, South Korea 7.8%. He believes China's level of development is still far enough behind compared to America that it has a lot of opportunity to have a high growth rate going forward. I would now like to review the outlook for individual commodities. The oil price has been weak because of reduced demand in China and the OECD countries, as well as excess supply. U.S. oil output has gone from 5.5 million barrels to 8.5 million barrels and could reach 10 million barrels within 3 years. The IEA estimates the demand has fallen by 200,000 barrels per day. Production rose 450,000 barrels per day in September because of increased output from Libya and Iraq. OPEC output surged to a 13-year high during September, 13-month high during September. OPEC will have a meeting in November, but there are no signs the major swing producer, Saudi Arabia, will offer to cut output. Saudis have decided to focus on maintaining their market share, not stabilizing prices. There's also a wild card with Iran. If the U.S. and Iran can reach a substantive deal in November to stop their nuclear development program, we will have to lift the sanctions we've imposed on Iran for several years. If we do that, Iran could increase oil exports by 1.5 to 2 million barrels. That would drive the price down a further $15 or $20 per barrel. Conversely, if we can't do a deal, there's a risk that next year Israel might launch an attack on Iran. Israel told us a year and a half ago they were very concerned about a plutonium reactor Iran was building in the eastern city of Awak. The Israelis said, we're going to take this out. They warned us they're going to do it. The Iranians have stopped production of this plant because of the agreement we've had here to try and end the sanctions. But if that deal falls through and Iran begins building this reactor again, there's no doubt in my mind Israel will attack it. And if they do, the price of oil could jump $10 a barrel simply because of fears about political stability in the Gulf region. The price of iron ore has fallen from nearly $170 per ton 3 years ago to less than $80 per ton because of concern about Chinese demand and increasing supply. We have big increases in supply coming over the next 2 years from both Australia and Brazil. These supply increases at a time when Chinese demand is faltering could drive the iron ore price below $80 per ton. Metallurgical coal prices have fallen to over $100 per ton from $370 in 2008. There is increased supply coming from Australia and Mongolia. Demand is increasing in China, the EU, and Brazil. but 1/4 of all coal mines in Australia are now losing money. Mine closures have reduced output by 16.7 million tons. This output adjustment could help to stabilize metallurgical coal prices at a low level. Thermal coal has been suffering from falling prices. The price has declined from $150 per ton in 2008 to $75 in 2014. Output is increasing from Australia, Indonesia, and North America. The growth in demand is about 2.5% per annum, but India may need larger coal imports to compensate for its drought and reduced hydropower supplies. Indian demand could produce a modest rally in the thermal coal price. The copper price has fallen from $6,780 a ton from a peak of $10,800 back in February 2011. Global copper demand is increasing at a healthy pace, while supply is increasing more quickly. In 2004, it will increase by 13.6% because of new output from Chile, China, Peru, Zambia, and the DRC. There are major new copper mines opening this year in Mongolia and Peru. There'll be another large mine opening in Peru during 2016. Mining companies made plans to open these mines when prices were much higher. Now that the price has fallen so much, we'll probably see less supply going out 2 or 3 years. So I see the copper price broadly in a lower trading range for the next 2 or 3 years. The aluminum price has rallied to $2,000 per ton to reach its highest level in 17 months. Demand has been increasing at a 5.6% annual rate, led by China, where demand will increase by 9% this year and 8.5% next year. China is also increasing supply. Its output will increase 10% this year and account for 52% of global output. There are plans to increase China's smelter capacity this year by 5 million tons. We lost 3.4 million tons in the last 4 years in Australia, the US, and Brazil. The market appears to be tight because of Chinese demand, while the recent price increases could create more supply. The result will be the price holding close to $2,000 per ton through the end of this year. The strongest metal this year has been nickel. The price rose 36% between January and June because Indonesia imposed a ban on raw nickel exports. They want the metal to be processed at home. And therefore, we had a major supply shock to China, which drove the price up quite sharply. China's making up for Indonesia by getting more nickel from the Philippines. But if we have the Indonesian supply stay off the market, I could see prices holding close to current levels for some time. Zinc prices have been firm because several major mines are about to close. They'll reduce output by 8 million tons between 2013 and 16. This will create a supply deficit of 322,000 tons this year and 470,000 tons next year. The supply constraint will sustain high prices. Lead's in the same situation. It's also being supported by supply concerns. The price this year will average $2,200 per ton because demand is increasing at a 4.7% annual rate. China is the biggest producer at 5.3 million tons, followed by North America at 1.8 million tons, and Europe at 1.75 million tons. Supply is being constrained by mine closures in Canada, Ireland, and Australia. Demand will be driven by the battery requirements for new automobiles in emerging markets. There will therefore be a supply deficit, which could maintain a relatively high lead price over the next couple of years. Indeed, the price could increase a couple $100s per ton. The gold price has been suffering from the strong dollar and concerns about when the Federal Reserve may raise interest rates. The lower gold price has made many mines marginal in South Africa. Demand has also suffered from a large decline in Chinese gold imports this year and continued liquidation of exchange-traded funds. They still hold 50 million ounces of the metal, so there could be further liquidation if sentiment turns more negative. Basically, gold is vulnerable to U.S. monetary policy and rising interest rates and a strong dollar. This will be a constraint on gold, I think, for the next several months. Basically, we thought 5 years ago China gave us a super cycle in commodity prices. We had, during the global downturn in 2008-9, only modest price declines because of the big increase in Chinese demand. China is now slowing, and that will be a constraint on commodity prices over the next 2 or 3 years. But there will be exceptions. Because of supply constraints, zinc and lead should hold firm, and nickel could also be firm for quite some time. So it's a mixed outlook, but China is the critical swing factor It's a critical swing factor in determining the overall tone of the market. Why don't I stop there and we can now take questions.
Thank you, David. Thank you, David. That's a very helpful summary of what's going on, and as always, we have to look to China. I'd like to maybe just start by asking maybe a general question. Can the recovery in the U.S. economy compensate at all for prolonged weakness in China?
The U.S. will make a difference, but it's not as dominant as it was 15 or 20 years ago. It used to be commodity cycles through most of the post-war period were driven by the U.S. economy, and to a lesser extent Europe. Now, China is so large in relation to America, the U.S. cannot fundamentally make up for a big decline in Chinese demand. Mm-hmm. But if we have China achieve a soft landing, keeping the growth rate around 7.5%, then I could see U.S. demand, especially in housing and automobiles, creating more demand for metals, and that could on the margin be a positive for prices. But the U.S. will not be the dominant factor. It'll still be China.
Mm-hmm. Thank you. I just want to open the floor up to questions from anyone else. We have about 5 minutes for questions on this. And I think there are microphones if anyone wants to ask questions. Does anyone? Yes.
The boom, the super cycle happened because of China's phenomenal growth. But then, are we not forgetting other, like India, Africa, and other nations in Southeast Asia and the Middle East that have to develop their infrastructure? Is there not scope for other areas to develop? Maybe not in the short term, but we have to think also further from China.
Well, India is an obvious alternative because India right now is only 30% urbanized. China is over half urbanized. India has a lot of catching up to do with China. And the new government led by Narendra Modi wants to make India a manufacturing power. They're right now a very modest producer of manufactured goods. In fact, they're a very modest producer of total goods in general. Their GDP is only about, I would guess it's only about 15 to 20% of China's GDP. So India, there's a lot of catch-up. Indonesia also has urbanization going on. The Philippines has urbanization going on. All of these will be, I think, net importers of various commodities or having less exports. So it's a positive as well. Africa has opportunities. Africa's now had, for almost a decade, a growth rate in the 5 or 6% range. Africa's urbanizing. Africa's having a lot of natural resource development. Africa's doing a variety of things better compared to what it did 15 or 20 years ago. But Africa is still not very urbanized. That change could happen over the next 10 years, and if it does, that would also create demand for steel, copper, other base metals used for infrastructure and capital spending. So no, you're quite correct, but it will take time for these markets to develop. They can't fully compensate for China in 2 or 3 years, but over 9 or 10 years, they could make a major difference.
Any other questions from the floor? I might just add another one. David, would you say, about a decade ago, the BRICS were the great fashion in investing and in talk about the world economy. Now we've talked about India and Africa and China. The other BRICS, Brazil, Russia, are not performing well.
No, they're not.
Do you expect that to change, or?
Well, Brazil will depend very much on the election this Sunday. The market doesn't like Dilma Rousseff, the incumbent, because she's been highly interventionist and done some real damage to major businesses. The market wants Osio Neves to win. Mm-hmm. And right now, the polls are a total dead heat. Mm-hmm. I was having dinner last week at the IMF meeting with the FT correspondent for Latin America. He told me, based on what he's seen and reading in the Brazilian marketplace, it really is a dead heat. But if Neves can win, I would see major changes in economic policy to revitalize Brazil, and I could see a growth rate a year from now heading back to 4%. But right now, Brazil is languishing. It's actually in recession at the current time. It's had 2 or 3 quarters of negative growth. Russia has major problems. The oil price has fallen sharply, and Russia depends very heavily on oil to finance the government. Now we also have Western sanctions because of the Ukraine. So I could see Russian growth turning recessionary here in the next 6 or 9 months, and being a real constraint as we go forward. If Putin does a deal on the Ukraine to get rid of these sanctions, that would be a major positive. But at the current time, there's no sign of that happening. So Brazil and Russia, I think, are very troubled, and it's not going to get resolved unless we have positive political developments. The election in Brazil and Putin changing his policy on the Ukraine. China, I've talked about. It looks pretty good. India, we've talked about. I think Narendra Modi is a major positive who will revive the economy. We had 2 years of 4.5% growth. Now we're back at 5.7. I'd like to think that by the end of next year, we could be back at a 6-7% range. India was doing 5 years ago 8 and 9% growth. The final member of BRICS is South Africa, and they're languishing. They had major platinum strikes this year. They had a strike in the automobile industry. It did tremendous damage. Their growth rate this year may be only 1.4%. And they've got real leadership problems. The president, Jacob Zuma, is deeply corrupt. He has no compelling ideas. Many South Africans told me when I was there in February, he'll win the election easily because the ANC is dominant. He'll be out in 12 or 18 months because the ANC cannot tolerate him for 5 more years as president. It'll produce huge electoral losses in local elections in 2016. But the major reason he wants to be president is there are 72 corruption allegations against him, and he could be tried on those if he's no longer as president. So there has to be a way for him to retire where he won't go to jail. So the speculation is they'll bring back his former wife as the president. Right now, she's the president of the African Union. 3 years ago, she was the foreign minister. The theory is because she has children by him, she'd protect him. And therefore, he could resign, retire, and step aside. But again, this is all very, very speculative.
Thank you, David. I think we should probably close this unless there are any more questions from the floor.
There's a question over
yes.
Thank you. I'd like to ask about the gold price. Like most economists, you spoke principally about the demand for gold, as an investment medium and so on and so on, without saying anything about the absolutely appalling state of the gold mining industry, which is bedeviled by low-quality, short-life, high-cost gold mines and great difficulty in raising new money to build new gold mines. Now, I know this is looking out more than the short term, 2 years or 3 years, but I mean, how on earth are we going to solve this conundrum?
I think we'll have to do it through higher prices. I admit that there's a lot of problems on the supply side. I mentioned South Africa. Half the mines are losing money right now. You've got lots of other mines which are high cost in different countries of the world, and they'll be constrained. We'll need to get the gold price, I think, back over 1,600 to get increases in supply or to make these marginal mines profitable. So you're quite correct. There'll be, I think, a big decline in supply. Keep in mind, the decision to build a mine in North America, Europe, and Australia takes about 12 years. To build a mine in Russia or China takes about 19 years. Other countries of the world also around 20. So these are very much long-term decisions. If we don't have visibility in a higher gold price, investment will suffer for quite some time.
Okay. I think we have to go on to the next stage, but I'd like to thank David again for a very interesting speech. And I'm sure if you've got more questions, you'll be available to answer them in the coffee break and that sort of thing. But thanks again, David.
Okay.